Hey everyone, this episode is brought to you by River, the place that I personally go to securely invest in Bitcoin with confidence and with zero fees.
If you said, Luke, what is one of the surest signs of where the bubble is throughout your career? I've been doing this almost 30 years. Every time retail and banks have been like flooding into something, it's usually a sign that that's the bubble. Guess what retail and banks have been flooding into for the last 3 to 5 years? Treasury bonds. Long-term treasury bonds are the bubble. And if long-term treasury bonds are the bubble, and as you just showed, 5% is the rate, they're not going to let it go over, then we should see what we've been seeing in markets, which is everything over long bond takes off.
I want to start off where we always start off, which is kind of your overall big picture. I don't think too much has changed since the last time we talked, because when we talked last, you were suggesting that maybe by early summer that they were going to have to really kind of devalue the dollar, and that was going to be the big play to kind of keep liquidity in the system. I don't think, because I read your weekly reports, I don't think too much has changed from that thesis. I'm just kind of curious if you have anything that's additive, or if I am off base, let me know.
I think we saw it's still, I think you're going to have to continue to add dollar liquidity. I think, as you know, as we've been writing for, probably a couple quarters now, that I'm not looking for some big devaluation, but rather orderly weakness really in the dollar. And maybe we've started to see it. We saw in April, I guess it was the second week of April, we had a really bad 10-year auction. And the 10-year yield got pretty sloppy, 4.75 up near 4.8. And I believe, if I recall correctly, because I was just writing about it recently, it was like April 15th or so. And we're now, in the ensuing month, we saw the DXY index from the high to the low move down about 2.2 or 2.4%, which doesn't sound like a lot, but in the dollar, that is significant. That is a significant increase in overall liquidity. And so we've seen that the dollar's kind of bounced off the lows a little. Was 104 flat. Maybe it traded under 104 for a cup of coffee. But I think that's going to be continue. Ultimately, the problem is global central banks aren't buying enough treasuries. The supply of treasuries is growing exponentially. And we're seeing, the QRA, the quarterly refunding announcement, I think was another sort of, another turn of the cards, right? Another flip of the cards in terms of this trend, which is to say, last November, we needed dollar liquidity. Yellen moved issuance, surprised people to the front end, basically tapped the reverse repo in a way where the effects of what she did matched QE to a T, but it wasn't QE. The purists will tell you it wasn't QE. I'm kind of like Tommy Lee Jones in The Fugitive, where like when Richard Kimball's pointing my own gun at me, I don't care, right? I don't care what you call it. Stocks up, Bitcoin up, gold up. Since they did it, liquidity was injected. Same thing with this May QRA. She did not move any issuance to the front end, but the Fed did cut long-term issuance. Right? QT, if you look at these two together, as we increasingly should, the Fed and Treasury, the Treasury cut long-term issuance in November, and the Fed cut long-term issuance in May. And so I think it's a nod toward this view of they're going to continue supplying whatever dollar liquidity is needed to keep the Treasury market functioning, to keep rates at politically and economically sustainable and palatable levels. And so I don't think a whole lot's changed on that front. It's sort of steady as she goes, if you will.
Yeah, I briefly brought up the Treasury chart there, and I also have a dollar chart that I might bring up here. When you're looking at the Treasury yield, the bond yield curve of the Treasury market here, let me bring it back up again. I'm wondering, how high are they going to let yields go? How far are they going to let it sell off before they just cannot let it sell off any further? And so here's the chart again for people that are curious, that are maybe watching this on video. Are we looking at this 5% level kind of really being the threshold that they just cannot allow it to go back through, where it it looked like the sell-off kind of peaked in October of 2023, and I'm looking at that level, and I'm saying to myself, I just don't think that they can afford to allow it to sell off beyond that threshold going into the summer. I'm curious if you would agree with that.
I do agree with that. And I think there is a case to be made that that number moves down over time, which I think makes, as you can see in that chart, right? So we saw the April peak, and we saw, that was right around the time when we saw 7 Fed governors jawbone the dollar down, and then Yellen followed up on November 1 with what she did, which I just described. But now we fast forward and we have sort of similar action. If you go to this latest peak at, whatever, there it is.
In yield. Yeah.
In yield. Exactly.
Yeah.
And,
there's
we can see sort of what I was just describing there. We've seen, so there's a case to be made that the red line of 5 may be coming down over time. Yeah. Is it coming down that fast? I don't know, probably not. I would say, I would agree with your view that 5 is a red line is probably pretty safe to say.
The only way they don't let that yield go higher really plays into the thesis that you've been saying for a very long time, which is they have to weaken the dollar in order for that to not make a new high, because the rest of the world has to sell their treasuries in order to defend their currencies. And I'm going to pull up the dollar chart here while we have this. This sell-off that you're talking about is right here in April in the DXY. And you can see for a month and a half now, the dollar has weakened, which has, helped keep the yields in the treasury market where they're at, and not putting in new highs with respect to the yield. So when I'm looking at this, I'm not seeing anything definitive that's showing a momentum shift or a change based off of the volatility. I mean, there's a lot of volatility in both of these charts. And so I guess for me, when I'm talking to an expert like yourself, I'm thinking, so what is different right now that you think that this trend is going to that the dollar is going to get weaker and that they're going to be able to cap the yields on treasuries? What is that key thing that you're seeing right now that you're not seeing in the price action of these charts that you think is changing that?
So I think it's the prospective possible / likely liquidity yet to come, right? So that's what we have to watch for, is when you see these news stories go by, they're not going to say, we're doing this to cap yields. It's going to be every other excuse in the book. The purists are going to say it's not QE, blah, blah. They're not doing this to finance deficits. Same thing they've been saying for 15 years. It's just happening a lot more frequently. I know it's a lot more urgent because of what we described before, the fiscal situation and the lack of central bank buying on net. So what are those things as I look out over the next 6 months? I see a Freddie Mac guaranteeing second mortgages, which the comment period ends today. It was
1.8 trillion. This is the 1.8 trillion?
As much as 1.8 trillion in liquidity, right? So when you hear, Freddie Mac is a government mortgage company,
yeah,
right? So what I forget exactly even what they're called. We know what they do, right? So
it's the government.
It's the government. So by way of background, about 30 days ago, it was put up for comment on the Federal Register, the proposal for Freddie Mac to guarantee second mortgages. When you hear Freddie Mac guarantee second mortgages, you should hear government guaranteeing consumer spending. When people take out a second mortgage, they tend to go on vacation, buy a car, put in a pool, put in a deck. This is
windfall. It's a windfall.
It's COVID Stimmy 2.0. What was COVID Stimmy 1.0? It was a government-backed consumer spending boom.
Yeah.
It weakened the dollar. It was in liquidity. It's the same thing. Now, interestingly, people I've talked to said that, number one, almost no one's noticed this. The Wall Street Journal editorial board wrote something about it on May 1. Their tagline was, "What could possibly go wrong?" And they're exactly right. And the people I've talked to said it's very unusual. This thing only had a 30-day comment period. It was like, here it is. Anyone have said, I put it up for proposal, second. Any objections? Tap, none.
There was less than 200 people that viewed this file, according to your report, correct?
Yeah, I think it was like 900 as of a week ago. I think it's up to like 1,300, right? Okay. So we're talking about something that could ostensibly inject hundreds of billions of dollars of liquidity and ultimately trillions into the consumer, especially if they do the same thing for Fannie Mae, and I don't know why they wouldn't eventually. And no one's paying attention to it. And so the comment period ends today. I don't know if that's at midnight or if it's already over. And so, okay, step one, this is when I say we have to watch for these liquidity injections. Okay, let's go to number two. Number two, last weekend, there were articles about how the U.S. banks had successfully pushed back on regulatory reforms led by Jamie Dimon at J.P. Morgan. Well, that sounds good. And the article talked about how banks were running the bank lobby, particularly in the financial markets, were running advertisements, I believe during the Super Bowl, the article said, talking about how these regulatory reforms were bad for American growth. Okay, these are bad. Call your congressman. The regulatory reforms are essentially designed to turn the banks into monetary utilities to finance the government. Basically, Treasury bonds are going to count against capital. Treasury bonds count against their capital ratios. Then when they buy Treasury bonds, they have to not make a loan somewhere else. And this is vastly oversimplifying, but this is the key thrust of it. These banks are fighting these regulatory reforms so that the Treasury bonds do not count against capital, which means they can buy infinite amounts of Treasury bonds. And if they buy infinite amount of Treasury bonds with no capital, that's QE through the banks.
Yeah.
More liquidity. It's really good for growth. It's really good for nominal GDP. It's good for employment. And that's the sort of, you have to understand what you're seeing and kind of translate it. The banks aren't wrong. This would be bad for growth, right? So if these regulations as they are written stand, government keeps running deficits, those deficits will crowd out private lending by the banks. The banks will buy the treasuries, risk adjusted, it's very attractive, blah, blah, blah. And they'll stop making loans to what the bank said would happen in the advertisement, small businesses, commercial industrial loans, et cetera, and the economy will slow. They're right. So the choice is do that and work down inflation, or suspend the regulations as it relates to treasuries, so treasuries do not crowd out the private sector when the banks buy them, and the government runs deficits, so the banks still make loans to the government, buy treasuries, and the banks still have the balance sheet room to make loans to the private sector. Dollar liquidity. QE without calling it QE. So those are the next two things I'm watching for. And again, this is not catastrophe. This is not, it just is what it is. This is how, when governments have a fiscal problem, they don't just go, oh, I give up. We're going to cut entitlements and defense by the amounts we need to cut them so that we can. It's not what they do, especially not in the geopolitical environment we're in. So what we're seeing is just this steady creeping changing of the rules, moving of the goalposts, not QE, dollar. And let me tell you, you tell certain people on Wall Street that they are financing the deficit, they will lose their minds. And maybe technically they're not because they're going through the primary dealers. And as I asked someone the other day, okay, yes, we're not a banana republic. This is not a banana republic move because they're going through the primary dealers. But answer me this. We know the primary dealers are backed by the government. They're too big to fail, right? Yes. Okay, so if a government-backed institution is the intermediary between the Fed and the government, that's semantics. It's semantics. And
here's where I would push back on the Wall Street person that says that they're not, doing that. There's already a massive divide between boomers and younger generations, right? Massive divide. When we look at what we're talking about, we're effectively talking about a $1.8 trillion stimulus to who? A person that owns a house already.
Free and clear. Yes.
Right?
Yep.
If you don't own a house, Do you get to participate in this $1.8 trillion stimulus that potentially is going to happen? Of course not. Right?
No, not till your parents die. Yeah, but yeah.
So when you pull back the thread and you look at who is this actually impacting inside of society, right? And you say, how is it benefiting them? Who is it hurting? Who's at the disadvantage of these policies that are being rolled out? And this isn't a banana republic. Well, actually it is. It is. This is total market manipulation where you're choosing winners and losers. And what's fascinating to me is the same set of people continue to be the winners on these decisions, these policy decisions, as they continue to roll them out. And so the more that they double down on the manipulation of the markets, the more that they're just ticking off and creating social unrest with a really interesting demographic, which is everybody that's young, because of these decisions that they're making. And it's we can get caught up in all the terminology and all the hoopla and describe how the banks are doing this and they're doing that. But at the end of the day, like the end user, the person that's being impacted in these decisions are the people that own the equity or they own nothing. And if you own nothing, you're going to even own less than the nothing you already have, because anything that's being printed is being jammed into the hands of the people that actually hold the equity. And that divide and that obliteration of the middle class just continues to accelerate. It's totally crazy. But curious if you have any additive. Sorry to go.
Well, it's interesting, right? Because the real reason we're doing this is because we're running these big deficits. That's right. So, but then you look at why are we running these big deficits? It's entitlements. So there's three things we spend our money on that matter. We bring in 4.8 trillion in tax receipts, roughly 4.6, I think, last year. We're going to spend 3.2 trillion this year on entitlements, health and human services, and Social Security. So that's Medicare, Medicaid, and that primarily goes to the boomers and the silent generation. So about 70% of tax receipts is going to entitlements. The next biggest line item is, of course, interest expense,
which is only going up.
Which is going up. And that's about $1.2 trillion on a gross basis, $1.2 trillion on a gross basis. Certainly pro forma.
Which is more than military spending.
Oh, it's 50% more than military spending.
Yeah.
And oh, by the way, every hegemon whose debt service has gone over its defense spending doesn't stay hegemonic for very long. Separate discussion.
Which is a massive foot stomp.
It's a very big thing. So this 1.2 trillion, who's been the biggest buyers of treasuries over the last 10 years? The biggest marginal buyer, other than the Fed and the banks, has been the boomers, right? It's been U.S. retail, particularly since they began raising interest rates. So they're getting more, the boomers are also getting more interest too. And then we've got defense at, call it 900 billion. So the point here is that the reason we have to do this in terms of this liquidity injection to finance these deficits, which are heavily driven by money that's ending up in the boomers' hands to pay for services that the boomers are ultimately consuming. But the boomers own the bonds. And so who's really losing in all of this? The boomers, right? So basically, there's two ways you could structure this. I've got to pay this entitlement. I can do two things. I can be overt about it. I can put it up for a vote, which will never pass. Well, it might pass now, actually, but forever it wouldn't pass, right? When you look at the demographics, the boomers are not going to vote for this. But now they're not the biggest generation anymore. They might pass. But I can put it up for a vote like we would do in a democracy, or I could just do it the easier way that governments always do. And here, raise rates. Hey, boomers, you can get 4 or 5%. Oh, great. I'm going to have 4 or 5%. All right. Jack inflation to 8. And like these boomers are going to sell their bond funds. Like, my dad last fall was like, when's my bond fund going to start going back up? It just goes down every year. Yep. Yeah. I said, that's probably going to stop going down on a nominal basis. Now comes the fun part where it goes from buying you, a house to a cottage to a tent. And that's how the boomers will pay for their own entitlements.
Yeah.
And the collateral damage to that is what you talked about, is the people who don't own houses, the people who don't own assets. And I think we're watching all of this happen. I think we're watching markets recognize this, start to recognize this in real time. When you look at, which is the $130 trillion bond market, recognizing it's the sucker at the card table. I mean, if you said, Luke, what is one of the surest signs of where the bubble is throughout your career? I've been doing this almost 30 years. Every time retail and banks have been like flooding into something, it's usually a sign that's the bubble.
Yeah.
Guess where retail and banks have been flooding into for the last 3 to 5 years? Treasury bonds. Long-term Treasury bonds are the bubble.
Yeah.
And if long-term Treasury bonds are the bubble, and as you just showed, 5% is the rate, they're not going to let it go over, then we should see what we've been seeing in markets, which is S&P over a long bond, boom. NASDAQ over long bond, boom. Gold over long bond, boom. Bitcoin over long bond, boom. Everything over long bond takes off. And because there's a reflexivity, markets are forward looking. They're not going to go, oh, rates are at 5, sell. No, they're starting to go, oh, rates are at 5. Here comes the next application of sugar. That's sweet, sweet liquidity from Powell or Yellen or whoever is going to generate it. But they're not going to eat less because rates are at 5. And if they're not going to eat less because rates are at 5, then the right thing to do is sell long bonds and buy stuff that goes up when they have to apply the latest round of liquidity.
Something that's desirable and scarce.
That's exactly right.
You had a comment that you think that they're going to potentially remove shelter from the CPI index. Were you serious about that?
That was more tongue in cheek, more than anything else in terms of their inability to get housing down. It was probably too cynical, but maybe not as cynical as it would have been 5 years ago.
I read it that way. I read it as you being a little cynical. So, this was a really interesting comment, and I would love to get into this, especially because I think it has ties to Bitcoin and AI. You said there's currently a backlog in transmission interconnections of 2,600 gigawatts. That is larger than the installed capacity of all power plants currently operating in the United States. What are you talking about here?
So one of my biggest investments, or one of my bigger investments personally, is a private equity investment in an electrical infrastructure equipment company. And one of the executives of that company here in Rust Belt, USA, sent out that update after being at a trade show. And what I'm saying is that the amount of requested, permitted grid build out, basically, right, is bigger than the entire installed base of current generation in the United States. And so when I see people be like short copper, I'm like, good luck. Have fun storming the castle, right? From Princess Bride. And that's not to say it can't go down, but like there is such a gross mismatch between the stated policies of our country and basically every country, right? Which is we're going to electrify everything, and the available capacity today, and then the prospective capacity when you look at, all right, how we doing on copper supply? How we doing with aluminum? How we doing with the industrial production capacity to make this stuff? Like the execs at this private electrical infrastructure company, they think they've got 10 to 20 years of open field running, like just as much business as they can do. And so when you then translate that to things like AI, and we're starting to see this a little bit in the headlines, is the bottleneck's energy, the bottleneck's copper, the bottleneck is all this stuff. So it introduces this really interesting potential paradox, which is for your and my entire professional lives, you roll out a new technology, it's disinflationary, it's a massive productivity enhancement, and it's deflationary. Mm-hmm. For the first time that I can recall in my career, this new technology is so powerful that the bottleneck are these industrial components and the raw commodities like copper and uranium and the industrial components and infrastructure to make this stuff. which introduces this really interesting paradox, which is for the first time in our lives, technology, the latest technology, productivity miracle might be inflationary, not disinflationary. Because then when you call up a chart, they call copper the metal with a PhD in economics for a reason. The correlation between GDP and electrical consumption is like nearly perfect, and electricity doesn't move without copper. So when copper prices start going up a lot, you can run a correlation with copper with inflation expectations in the US, copper with inflation break evens. AI is going to make rates go up because they're short the copper and the electrical infrastructure and energy. It's going to be and you would think it's completely the opposite. So I think that gigawatt comment really was like, sometimes you just hear these comments that just smack you across the face. The last time I recall hearing one like that was, we used to cover, in a former life, we used to cover a coal mining company called Joy Global. They did drag lines and I forget what the other kind of giant coal mining machinery was, but these are like, at the time, they were like $20 to $100 million rattle machines, huge metal machines. And we went and met with them in like 2002 or 2003 or something. And they're like, our order book is extended out like years. The Chinese are buying everything we can make. And we're like, okay. And the stock just went for the next 6-7 years.
Yeah.
That's the last time I remember hearing something like this with that gigawatt comment, right? Where you're just like, there's two choices. We don't have the grid to do what we want to do with electrification. Full stop.
Yeah.
And so then your answers are, do we not do it? Or do we do industrial policy and the Fed cap yields ultimately, one way or another, to do it? And you're seeing signs it's the latter.
Is AI the thing that's driving this massive increase in energy?
It's a part of it. It's a big part of it, but I mean, that's still early days. I think it's more just
the data center.
There are things. It's the data centers. It's the it's the EVs. Like, even the small amount of EVs. People, again, Doomberg did a great piece about a year ago where he said the average transformer that we use in sort of, and I apologize to any people who really understand the electrical grid stuff, because I'm not that guy. I know, like, not even enough to be dangerous. I'm just dangerous. So I don't know what size of transformer this is. Whatever size you use, you kind of see on the poles, that's sort of for like a neighborhood or whatever. At any rate, Doomberg pointed out that these transformers are designed to run on a cycle. So they're supposed to last 30 years. And the way they last 30 years is during peak hours, like you have in a grid, right? Max power use, they get really hot. And then at night, when use is much lower, they cool down. And so they cycle down, they cool down. And it's that cooling period that allows them to last 30 years. Well, what Doomberg pointed out was that
they're running hot.
Well, yeah. When does everybody plug in their cars? At night.
Yeah.
When we never used this stuff before. Okay. That takes the temperature of these things and runs them hot 24/7. Okay. What happens to the useful life of a transformer? How far does it fall from 30 years, driven by just a token amount, not nowhere near our goals for EV penetration, but just once you hit sort of some threshold on EV penetration, how far does it go from 30 years? It goes to 3 years. They cut the useful life of transformers by 90% by plugging in your cars at night.
Really?
And I run this by, these friends of mine at this electrical, and they're like, yeah, that's
really
direction.
That's insane.
So there's a degree of reflexivity in this that Wall Street is not thinking about. What? They are just not thinking about. The average investor is not, well, let's just plug it all in. AI, cars, electrification. No. There's an order of operations, fellas, and it all runs through copper. Like, it's all got to go through copper. Then it's got to go through the U.S. industrial base and electrical infrastructure and aluminum. And like, like copper's probably not priced in the right friggin' zip code if we want to achieve what we want to achieve. And again, that's fine. That implies some massive secular investment shifts in terms of, look, if copper's the bottleneck for AI, copper's an AI play, baby.
Mm-hmm.
If the price of copper's, going to 10 from 5, like it's not like you're not going to buy the copper.
Yeah.
And so people say, why is China buying up all this copper? And why is China buying up all this nickel? Why is China buying up all these metals? They're getting ready for war. Maybe. Or more likely, in my opinion,
data centers. Yeah.
They know, like, if you knew something, if you didn't have to market, and China doesn't, for 2 years, if you knew in 2 years copper is going to be 15 and today it's 5, how much copper do you buy if you don't have to market? Because maybe it goes to 4 first. Yeah. And of course, the American way of doing it is, I'm not going to buy it if it's at 5 because it might go to 4 or 350 before it goes to 15 because we all have to mark our books to market monthly or quarterly. And China's like, okay, I'll take it at 5. And if it goes to 4, I'll buy more. If it goes to 350, I'll buy more. And like, I don't know why these people keep selling me all this stuff because it's going to be 15 in 2 years or 3 years if they look at their own plans for EV. And the 15 is a random number. Maybe it's 8, maybe it's 9, maybe it's 10, maybe it's 20. I don't know. But it's higher. Like it is so obviously higher, barring some sort of catastrophic or some sort of productivity thing, right? We have we have a way to not, we can do this wirelessly. We can transmit electricity wirelessly and we don't need the copper. Okay, that changes everything. But like the people that are building the grid, if we have this and we're going to use it, you probably ought to inform them because they got 2,600 gigawatts of sort of stuff to build, which is bigger than the entire grid. And no one's let them know, like, hey, don't worry about the wire yet because we can do it wirelessly. Right now, unless it's classified, it doesn't exist.
So just for folks listening, 3 tickers for companies that have a market capitalization that deal in copper in excess of $1 billion. You got FCX, IE, and BVN. That first one, FCX, Freeport. This is a $67 billion company. I haven't dug into any of those tickers. I'm just did a quick Google search and just, throwing out a couple names of companies that deal in copper. So, and is that how you would play this, Luke? I'm assuming you would buy the companies that are mining it, or are you like actually going into the futures market and trying to own copper? How do you play this?
For me, and I can't make individual securities recommendations, but from a trade structure standpoint, if I was an average investor, I wouldn't get involved in the futures. That's a tricky game that's better served for professionals given the leverage involved. I would be more inclined to own copper producing companies with good balance sheets, low debt to cap, because it is, I don't think it's gonna be a cyclical business for a few years, but it is in the long run a cyclical business. So that to me is, I think the safest and best way to play for most people.
But I would think if the dollar does weaken, like we talked about earlier, these are going to rip. I would think. Yeah.
Yeah.
How about on the uranium front? Because you had quite a bit that you were talking with respect to that as well. And this is, again, another energy centric type position based on the increasing expectation for energy demands all around the world. I also read that Japan was starting up one of their nuclear reactors. What are some of your thoughts on this?
I've not dug in as deep to it other than tangentially, but to me, I look around and I see a lot of countries coming to the recognition that they're short electricity relative to their plans and goals, and that nuclear is the best way to implement large amounts of baseload capacity. And the supply side of it, again, by what I can tell, is also relatively tight. You saw last week the U.S. government is not even basically, they just implemented, in the aftermath of sanctioning Russian uranium, they implemented a program where they're basically going to spend $3.4 billion to sort of buy up uranium and try to stimulate the domestic uranium industry, which is fine. It's the right thing to do. It's a good strategy, but that yields conclusions, which is that's industrial policy. The American government is selling treasuries to buy uranium. Why wouldn't I sell treasuries to buy uranium? Why should many investors sell treasuries to buy uranium? I think you should. So I think the outlook for uranium is very good. I think it was Amazon a few months ago, I think dropped several $100 million to buy a nuclear power plant for themselves to help run. So we've got this technology company with all this amazing, they run web services. They've got, all of this tech, and they're buying a nuclear power plant. Why? I'll tell you why, because they see what I was just talking about in terms of the mismatch between interconnection applications and the lead times and the existing capacity. And so they're dropping several $100 million on a nuclear power plant because they think it's getting to the point where it's not what's the cost, it's what's the availability. What's the value of Amazon if they don't have enough electricity?
Yeah.
I don't know what it is, but it's hundreds of billions of dollars less in market cap. So who cares? Drop several $100 million on a new power plant. Make sure your uptime doesn't go down as a result of your electricity hookup. Microsoft has talked about buying nuclear power plants for their AI type stuff. So I think you're going to see more of this, which again breeds this interesting question, which is if I take a look at the multiples on copper and uranium and I electrical infrastructure and I contrast it with the multiple on true AI stocks, and if the AI stocks don't hit their goals without the former, then the multiples should probably at least be a little closer together on the stocks and the earnings multiples, right? So I'm not saying they should trade at some insane, high multiple, but they probably should get a little bit of a pickup from being stocks that the AI stocks can't live without. So that's how I'm thinking about it at the moment. I think it's kind of interesting. But yeah.
One of the most common questions I get asked from family and friends is, Preston, where do you personally buy your Bitcoin from? And the answer is really simple. I buy it on river.com. Not only can you easily buy Bitcoin with zero fees on recurring orders, you can have peace of mind knowing Bitcoin on River is held one-to-one in multi-sig cold storage, all while being fully licensed and regulated in the United States. Plus, their relationship managers are US-based and available by phone for you or your business. Additionally, River has built their own infrastructure from the ground up, which means they don't rely on third parties to function like other Bitcoin exchanges. River also just created a new feature not found anywhere else called River Link. It allows you to send Bitcoin over a text message to easily orange pill your family, pay a friend for dinner, or send a gift. There's a new standard for investing in Bitcoin, and River is setting it. Go to river.com/fundamentals and get up to $100 free when you sign up and buy Bitcoin. That's river.com/fundamentals. In a world where convenience often compromises security, many investors settle for solutions that do not fully meet the demands of Bitcoin security. That's where the Bitcoin Way comes in. Offering a personalized white glove service, they will guide you through every step of the way to achieve full self-custody, ensuring you adhere to the strictest self-custody standards. Their experienced team helps establish robust security practices that cover all aspects of self-custody, cybersecurity, and privacy. Their ultimate goal? To empower you to become fully sovereign. Beyond securing your Bitcoin, they also offer services such as inheritance planning, Plan B strategies, assisting in relocating to Bitcoin-friendly locations to further enhance your sovereignty, and much, much more. Take the first step to true financial independence. Visit thebitcoinway.com/TIP to schedule your free consultation call. Don't delay in securing your generational wealth the right way. Opt in for security over convenience and protect your future. Your family line will thank you. I've got a chart I've got to bring up here. This is such a bloodbath. Look at this. Look at this whopper. Japanese bond yield curve, Luke.
Yeah.
I mean, this is crazy. This sell-off is totally insane. Like, we're back to yields in Japan that were there during the great financial crisis. And I mean, it looks like it is just going to continue to fall apart. So when I think about where this is in relation to all the other yields around the world, this really kind of seems to be the canary in the coal mine. And I'm curious if you would agree with that, with respect to just there is a brisk change playing out in fixed income. Do you have any other thoughts or like opinions when you're looking at this? And I can also show the Japanese yen, which we're seeing against the dollar at levels that it hasn't hit since 1990, which I also think is incredible. Um, what are your thoughts, Luke, when you think about Japan and some of these charts?
I think it is a canary in the coal mine. Japan is one of the world's biggest creditors, right? They've been running surpluses against the West, certainly against the United States, certainly, for I don't know, 60 years. And what do they do with those surpluses? They reinvest them into American assets. So ultimately, we can see that those yields, and we can then game theory or game out what the possible options are for them, right? So that goes up, that puts pressure on everything. It puts pressure on in Japan. What does Japan want to do? They've got $3 trillion in dollars denominated assets sitting in America. They could say, listen, we're going to finance our deficit to defend our currency for, we're going to sell 5% of that every year. We're going to sell 10% of that every year. So we'll sell $300 billion worth of dollar assets a year for the next 10 years, and it could probably go longer than that.
But on that front, they just opened up swap lines to them. So why, if I'm Japan, why don't I just beg for mercy and say, open up the swap lines? I'm not going to sell my treasuries. Just help a brother out would basically be my strategy. And it seems like that's the strategy that they're taking. Is that it, or?
Well, that goes right back to our initial discussion, right? Which is, that's not QE. Those are just swap lines. They have to be bought back.
Yeah.
But if the alternative was them selling treasuries, what are those swap lines? Financing U.S. deficits, right? Financing net U.S. deficits. Because otherwise, Yellen would have had to sell her $2 trillion. The Fed would have had to sell theirs. And Japan's going to be going, you know what? You take these. I need the dollars. So the punchline is the treasury yield would start to look like that. That would be, that's what it would start. The 10-year treasury would start to look like that. And we can see that if you chart, it's a 2-axis chart, so take it with a grain of salt. But you run the yen against the 10-year treasury, so the weaker the yen gets, the higher the dollar yen goes, the weaker the yen gets, the higher the 10-year treasury goes. For the last 5 years, it's like a very tight correlation. And so
Luke, in all of this, just so people can understand, so what's the impact when they open these swap lines and they allow this to take place? Japan benefits before the United States benefits. But if the US didn't open these swap lines, we would have total dysfunction in the treasury market, and everything would go chaotic globally. So it's kind of like you and I are in line to go on a ride or something like that. And I put you in front of me, even though it doesn't benefit me for you to go first. But if I don't go first, we basically both die or we both fall apart. So we're here helping out all these countries around the world by opening these swap lines, just so we can keep the dollar stable and normally functioning at the expense of every U.S. citizen and their purchasing power and their ability to buy equity around the world, because they've basically given that liquidity to somebody else first. Is this a correct description?
Generally, yeah. It speaks to when you're highly levered, there typically aren't linear, gentle, soft landing outcomes. They get very, very binary, right? So, okay, we don't open the swap lines. The Japanese sell treasuries. The yield goes up. The dollar goes up. As the dollar goes up, global growth slows. As global growth slows and treasury yields go up, the amount of global selling of treasuries accelerates. The net effective supply of treasuries accelerates. Yellen plus everybody in the whole world, right? So Yellen sells 2 trillion, the Fed sells whatever they're still selling, and the world sells, the world could sell $1 trillion a year for the next 8 years. Central banks could sell $1 trillion a year for the next 3.5, 4 years. So, okay. And we know that market's not very liquid. It's not, certainly not that liquid, because we've seen it dysfunction 3 times in the last 2.5 years. So that we go into a death spiral globally, right? Because, oh, by the way, treasuries are the collateral underpinning the whole system. And we started to see the impact of that last spring. It wasn't a banking crisis last spring. That was a treasury problem. The collateral underpinning those banks had fallen too far. And so the Fed wrote the collateral up via BTFP swaps to keep those banks in a decent position. That's option one. That's extreme option one. We started to see us go into that in 3Q23 when we saw the long-term treasury market fall 20% in a quarter. Option number 2 is not like, well, let's just do Goldilocks. Option number 2 is, okay, do the swap lines, do whatever liquidity you need to do to keep treasury yields from going too high, to keep the dollar stable to moving down, and to kind of keep, but the release valve then is S&P up versus, like this versus the long bond, NASDAQ spiking versus the long bond, gold spiking versus the long bond, Bitcoin spiking versus the long bond. Those are the two out. It's fire. It's ice or fire. That's it. There's not like, hey, can we make like a nice warm tea out of the ice and fire? It's ice or fire until you write the debt down significantly. And we've seen ourselves going back and forth. And sometimes we spend a little time between the two, but it's not like, hey, we're going to spend the next 2 years sipping a nice cup of tea blended of ice and fire. It's going to ice, fire, ice, fire, ice, fire.
I don't think that even writing it down solves the issue at hand, which is that you have productivity through about to be AI and what that's going to do. And you're trying to measure all of this with a fractional reserve system that has to keep expanding. And so I just don't see them writing, quote unquote, writing it down being anything other than yet another Band-Aid on a wound that is bleeding out aggressively. You have to get to some type of sound money in order to have the quote unquote write down in a way that the world can move forward in a way that incentivizes cooperation as opposed to incentivizing everybody at each other's throats.
No, that's exactly right. And it's, as you know, our friend Jeff Booth wrote the great book Price of Tomorrow. And that's absolutely correct. It's absolutely, and that's something, again, Wall Street by and large is not paying a lot of attention to, which is,
I don't think Wall Street understands that.
It's difficult to get a man to understand something when his salary depends on his not understanding it.
Yes.
Which is to say a debt-backed system, a debt-based system is fundamentally incompatible with a deflationary technology like AI.
Yes.
People aren't getting that yet. Setting aside how AI might actually inflate commodities, like we just said.
Yes.
Set that aside as a trigger of inflation. Let's say AI arrives too fast or just at a reasonable pace. It arrives too fast relative to the pace not needed to do this. You're going to create wage deflation, right? There was a great paper on humanoid AI robotics, right? And the paper on it a couple of weeks ago, we wrote about it, and it's something that again, Jeff Booth introduced me to as a concept about a year ago. They think AI humanoid robots could send the median wage in the world down to $1 an hour by 2034. Let's say they're wrong. It's only $10 an hour by 2034.
Still.
Who pays the consumer loans, right?
Yeah.
So the wage level is going to drop. Pretty much every consumer loan out there will default.
Yeah.
Okay, are they going to let the banks blow up? Well, we know they're not going to do that. What are they going to do? They're going to print the money to save the banks, because guess what the banks are going to sell to get liquidity as their consumer loans default from this deflationary wage? the $4.2 trillion in treasuries and mortgage backs they own as high quality liquid assets, just like they did last spring for Silicon Valley and Signature Bank. Well, that's not good because now it's a treasury market problem again. And we know they're not going to. So AI means the end point of AI, to your point, in the presence of a debt-backed system, means central banks are going to have to fully reserve all the debt or the substantial majority of the debt. That's where AI leads us.
Mm-hmm.
And I don't think that's understood yet. And so, the way I've been positioning for it is keep my own balance sheet low, do not take on consumer debt I don't need. And from an investing standpoint, understand that neutral reserve assets will outperform everything else as the deflation of technology forces central bankers over time at an accelerating pace to fully reserve
Everything.
all the debt. And the price level will adjust. And there's like an easy way to do this and a hard way, but it ends up the same way either way. And this part is not understood. But when I see all the stuff about AI, and it's almost, I don't know if they're just not thinking that far ahead, or if it's one of these things where it's the boogeyman in the closet. You can't, if I worked at a big Wall Street firm, you can't do that. The consumer loan guys will come over and kick your head in, right? What are you talking about? Stop. I don't, so I can.
When I'm looking at this and I'm looking at it picking up and accelerating, and who knows what that timeline is, and there needing to be some type of buyer for all of this issuance that we know is coming, that has to come. I think you and I have talked about this very briefly, Luke, about stable coins effectively being the transmission mechanism for them to have a buyer for all of this garbage, and it's going to have to be short duration garbage. I was blown away when I saw the former Speaker of the House. He ran as a vice president. You saw this clip as well. I can see you're nodding your head. Paul Ryan talking about how important stablecoins are moving forward, and basically literally getting into this argument of them being buyers of treasuries. And when I watched this clip, I was like, oh my God, they, meaning Washington, have finally figured out what's happening here and where this is all going. And I was a little taken aback by all of this, because in my mind, they are totally missing how this transmission mechanism is going to take place for the buyer of all this garbage. And now it seems like they're figuring it out. It looks like they're implementing policy to embrace this. And, you and I have had this opinion for a while. Nobody needs this more than Washington, these stable coins. It's just taken them a long time to figure out. Would you argue that all these politicians on Capitol Hill have started to actually figure this out, or is that Paul Ryan clip just kind of like a one-off thing?
I think the Paul Ryan is an interesting, because I think it's a signpost on timing. In other words, that they're talking about it now, because over the last, call it 6 months or so, I've had a couple of conversations where it was made apparent to me.
I love how you're trying to make sure you don't dox anybody. Or Go ahead. I will not interrupt you, Luke. Go ahead.
No. You get it. In the aftermath of World War II, think about where we were on May 10th, 1945. Europe flattened. Russia flattened. Japan flattened. England deindustrialized. The world was looking at a period. Now, from a classical economics standpoint, what that means is the capital of the world was destroyed. It was gone. The retained earnings of 2,000 years, gone. Obliterated. That leaves one of two paths. We spend the next 60, 40 years, 2 generations, maybe 60 years, slowly rebuilding the capital obliterated over 200 to 2,000 years of capital obliterated, little by little, right? So we eat hand to mouth, and we try to save a little bit. We take the retained earnings, we put it over here in a pile, and we fold it there someday. And then we add the next year and the next year. And someday we have enough to rebuild the roads. And then someday we have enough to, once we rebuild the roads, to rebuild this and rebuild that. Okay. That's option one. Option two is you move to a system that you'll have to move back away from at some point, where debt becomes an asset. I will go into debt to rebuild you. You will hold the debt as your asset. And by doing this, we can pull forward the 40 years of rebuilding to a much shorter period of time. In reality, if we rebuilt it over 10 years, probably much longer than 40 years, right? It would probably take you 100 years to rebuild from that using the first way. But we've always known it's a problem. Triffin's dilemma told us it becomes a problem at some point. You cannot, and this is the first time in human history, as far as I'm aware of, where it became so widespread that the debt became the asset of another in such a large way. Ultimately, it's my understanding that it's always been known that at some point you've got to go back to a more equity-based system, something that is not a debt-based system.
Yeah.
The fact that you're seeing people like Paul Ryan say these things, the fact that you're seeing central banks buy gold, not treasuries, for going on 10 years now, is a hugely important message. When central banks buy gold and not treasuries in the context of what this 80-year process of rebuilding from the 1913 to 1945 period, that's telling you the central bank saying that system's done. We are starting the transition to a neutral-based system. And so when I see Paul Ryan say things like that, it's really interesting to me. When I see Janet Yellen say, for my entire career, she's a 76-year-old woman. For my entire career, I thought that if someone wanted to send you cheap goods, you should send them a thank you note. I would never again say, send China a thank you note. She's throwing 40 years of economic orthodoxy in the trash. National Security Advisor Jake Sullivan getting in front of the Brookings Institute and saying the last 40 years of U.S. economic policy has been wrong. So there's this building theme of a move toward this equity-based system. Now, like what tactically, what no one's talking about yet, I suspect you probably have, but not a lot of people, is if you use stablecoins, you're not going to be putting 10-year treasury bonds and 30-year mortgages and these things because of the duration mismatch. Just be all T-bills. And so if you
which works for both parties, it works for
everyone.
Yeah.
It works for everyone.
Yeah.
It works for everyone except the retail we've plugged with all these long-term bonds. Remember what I said before? Are long-term treasury bonds.
Yeah.
If we use some version of stable coins backed by T-bills to sort of redo this, the release valve is inflation. It's going to go bonkers. You're going to have like very high rates of inflation, which is fine. You're going to have very high rates of nominal growth. In fact, I suspect it will be spun as preparing the dollar and the U.S. for growth or something like that, right? Who could be opposed to growth? Well, don't tell the boomers whose bondholders are about to go from buying them a house to buying them a tent. Like, it's fine.
Who is buying that garbage? Who's buying anything that's long duration bonds of any country right now? Who's the buyer of all that?
I think it's duration, pension funds, duration matching. Like if yes is the short answer. But like, look, the dog that doesn't bark in that whole equation is, if that market is so deep and liquid relative to the size of our deficits, why isn't Yellen terming it out? And the answer is either A, she's stupid, she's not, or B, the market's not that deep and liquid out that far relative to the size of our deficits. So, they can place a certain amount of it with organic buyers of it, but
they could roll it. They could just roll it too. Couldn't they just gobble it up and then reissue it as short duration?
Well, they could, but that's, and they've done that to a certain degree. They've talked about doing it earlier this year. When we talk about those dollar liquidity injections. Waller at the Fed came out, I think, on March 1 and said, you know what? We have historically had a quarter of our holdings of our balance sheet in T-bills, and it's like 3% now. We want to move back towards a historical amount. Great. And think about it. I'm trying to break it down. So the shorter the duration of paper you issue, the more it's like money printing, right? Think of, I hold my money in cash, right? Well, what's cash?
Yeah.
Cash or T-bills? Cash, T-bills, cash, T-bills. If the government is running massive deficits and issuing it more and more in T-bills, the government is more and more printing straight cash to finance its deficits. It's inflationary over time, very inflationary.
Yeah.
Which is, again, that's in the cake. Like if we didn't want this, we shouldn't have done a lot of the dumb stuff we did for the last 20, 30, 40 years.
It's already, I tell people all the time, it's already all been printed. It's all out there. They just got to convert the duration into something short duration and then have a bunch of stablecoin people buy it up over the next 10 years.
No, it's the $130 trillion going, wait a second. I'm the sucker at the card table. Oh God, the $130 trillion bond market. And except you can see it happening in markets in front of us, and it's going to continue to happen because, again, to believe it isn't going to happen requires either a productivity miracle or a belief that the United States government is tomorrow going to cut entitlements and defense by 25 to 30%, meaning, immediately, permanently, and then stand aside as those cuts lead to a financial crisis and a depression worse than the great financial crisis. There's zero chance that's going to happen.
Last question I got for you is, what are you hearing on Bitcoin from Wall Street?
I'm hearing just demand is really good. I'm hearing demand's really good. I'm hearing, you can see that in some of the, some of the filings that we saw last week. If everything we have said is even directionally true,
hang on.
We know, right? Like it is, the common knowledge game is such that it is, I think everybody knows that sort of the cleanest, one of the cleanest, easiest ways to play that is on Bitcoin. That one of the most leveraged ways to play what's happening is Bitcoin. And so I think there is a growing recognition of that on Wall Street.
It's not even 2 trillion.
No, I know it's. It's what, trillion four right now? Trillion like 4.5, something like that. Yeah. It's still very early days, in my opinion.
Yeah. I could talk to you all day, brother. I really could. I love these chats.
Likewise.
Yeah. Thanks for making time and coming on. For people that are listening, I'm a massive fan of Luke's report that he writes. I am a subscriber of his report. I read it every Friday as soon as it hits my inbox religiously. And I just, I love having you on, Luke. And anything else that you want to highlight to the audience?
No, it's I appreciate you having me on. And I always enjoy our conversations immensely as well.
Likewise, sir. All right. Well, thanks for joining me, Luke.
Thanks for having me on, Bob. Inflation's going to pick back up. I think stock prices are going to pick back up. I think you will get talk of rate cuts going away and possibly even rate hikes. And I think the surprise will come around mid-year when the rate hikes don't come. Everyone that is like, okay, they're managing this thing for inflation, that will be the moment where they go, oh my God, they're managing this thing for deficit. They're managing this thing for Treasury functioning. That's when you're going to see fireworks.